Welcome to the SmartKeys podcast. Right now, heavy industry is responsible for roughly a third of the world's greenhouse gases.
Yeah,
And yet,
full third,
right, a third, yet it's receiving just 7% of climate funding.
which is wild.
It is. So today, we are setting out on a deep dive into this absolutely brilliant data-driven article that explains exactly why that is happening and, why it's actually a massive opportunity for you.
Exactly.
The piece is titled Climate Tech Trends, Innovating for a Sustainable Future, and it's written by Felix Römer. You can find it over at smartkeys.org. Now, our mission for you today is simple. We are treating this article as a comprehensive strategic resource for modern professionals.
Yeah, we're not just, skimming the surface here.
No, not at all.
Hmm?
Whether you are an innovator trying to build the next big thing, or an investor deciding where to deploy capital, or honestly just someone looking to understand the future of business efficiency, this deep dive will extract the exact insights you need to stay ahead.
That's exactly right. We aren't just going to read high-level trends at you. We are going to translate a massive, comprehensive data set into a practical roadmap.
Yeah.
I mean, the research we are looking at tracks over 12,000 startups and 52,000 deals.
Wow.
Yeah, worth a staggering $600 billion since 2013.
That scale is almost hard to wrap your head around. I mean, $600 billion over a decade.
It's huge.
It is. And, to set the stage for you, as I was reading through this research, a specific image kept coming to mind. I realized that the climate tech market right now is essentially like a teenager who just grew up.
Oh, I like that.
Right, because for the past few years, we were in this massive hype phase. It was like a teenager with a seemingly limitless allowance from their parents.
Unbounded enthusiasm.
Exactly. Unbounded enthusiasm, massive valuations, and frankly, a lot of conceptual projects that just didn't really have a workable business model. But that era, it's over. The allowance has been cut off. Now, climate tech has to get a job, pay the bills, and, prove real, undeniable value.
That is a perfect way to frame it. The market is maturing, and what that data shows is that while the initial hype cycle is gone, this market maturation is actually where the real structural money gets made.
Yeah.
That is, if you know how to navigate the new rules of the game.
Right. So to understand how you can win in the future, we first have to look at the macro reality of the present. I was reading through the first section of the report, and I have to admit, the global numbers terrified me at first.
They look pretty grim initially.
They really do. It felt like a massive contraction. Can you walk us through what actually happened to the funding landscape recently?
Yeah, so it definitely looks like a severe contraction on the surface. Overall, global funding in climate tech slid 29%.
Wow.
Yeah, it dropped from $79 billion down to $56 billion. The sector's total share of venture capital and private equity dipped down to 8.3%. And if you look globally, the Asia-Pacific region, APAC, pulled back significantly, dropping from 19% of the share down to just 7%.
Okay, let's unpack this.
Right.
Because if I am an innovator or professional listening to this, and I hear that funding is down by nearly 30% globally, and APAC has massively retreated, how is this a good environment for a business or an individual to operate in?
I know, it sounds bad.
It sounds like a bubble just burst.
Right. But what's fascinating here is that the drop in funding isn't a sign of the sector dying. It's just the retreat of inexperienced investors.
Oh.
Yeah, we call them tourist investors, the ones who jumped in during the hype cycle expecting quick, software-style returns from really complex physical hardware problems.
And they realized hardware is hard.
Exactly. They realized hardware is hard, and they left. But the seasoned, dedicated backers, they remained. And deal-making has actually shifted up the ladder.
What do you mean by up the ladder?
Mid and late-stage deals rose to 37% of activity in early 2024. That's up from about 20% just 5 years ago.
So the money is still there, it's just consolidated at the top.
Exactly. And also, the U.S. market held remarkably steady at about $24 billion.
Really? Despite the global slide.
Yeah, largely because of policy tailwinds, specifically the Inflation Reduction Act, the IRA. It's providing the certainty that capital craves. But those seasoned investors who are sticking around, they're demanding bankable systems.
Bankable system?
Yes, they want clear unit economics. And just to clarify for anyone not deep in the finance weeds, unit economics means you actually make a profit on the single widget or service you are selling right now.
You aren't losing money on every sale.
Right. You aren't losing money on every single sale and just hoping that magically scaling up to 1 million customers will fix your fundamentally broken business model.
Right, right.
They want a proven path to cash generation today, not just an inspiring pitch deck about tomorrow.
The allowance is cut off. You need a job.
Exactly. You have to prove your math works today.
So if these seasoned investors are demanding this strict bankability, we have to ask, where is that smart money actually flowing right now? Let's look at the winners first.
Sure.
The data shows energy and AI are completely dominating the landscape. Energy ventures captured roughly 35% of the funding.
It's massive.
And we are seeing massive, concentrated bets here. I mean, multiple raises north of $1 billion just in green hydrogen and alternative fuels alone.
And that makes total sense. Energy transitions like green hydrogen, which, by the way, is the process of using renewable electricity to split water into hydrogen and oxygen.
Right, rather than extracting it from fossil fuels.
Exactly. It offers a clear one-to-one replacement for existing massive energy markets. It's a huge infrastructural play.
And then on the other side of things, you have AI-centered climate ventures raising $6 billion.
Yeah, AI is huge right now.
It is. 62% of that AI funding is going straight into autonomous mobility, while the rest is hitting predictive agriculture and smart energy.
Because AI is the ultimate optimization tool. Take predictive agriculture, for instance.
Okay.
We aren't just talking about a farmer looking at a weather app. We are talking about algorithms ingesting real-time satellite imagery, ground-level soil moisture sensors, and historical crop yield data to tell a farmer exactly which square meter of their field needs water or fertilizer today.
That's incredible.
It offers immediate productivity wins. Investors love it because it's software. It scales infinitely with almost zero marginal cost.
Right.
But this hyper-focus on AI and clean energy is creating a massive blind spot.
A glaring gap. And this is a stat I mentioned right at the top of the show, which just blew my mind. The hard-to-abate sectors.
Yeah.
We're talking about heavy industries, steel manufacturing, cement production, the built environment. These sectors account for roughly 1/3 of all global greenhouse gases.
Yeah.
Yet, investment in these areas absolutely plummeted down to just 7% of climate tech investment.
It's a huge disconnect.
It really is. Here's where it gets really interesting. To me, this is like spending all of your money buying a state-of-the-art smart home system, complete with voice-activated lights and predictive thermostats, while completely ignoring the fact that the foundation of the house itself is crumbling into the earth.
That's a great analogy.
Why is the venture capital world ignoring heavy industry?
It comes down to friction, capital, and risk. Heavy industry requires incredible capital intensity. CapEx, or capital expenditure.
Right.
You cannot write a software code to make green steel. You have to physically build a new type of electric arc furnace or a massive cement kiln.
Which costs what, millions?
Hundreds of millions of dollars before you ever sell a single product.
Wow. So the upfront price tag is just too high for a standard VC fund.
The price tag is high and the payback period is incredibly long. But the biggest factor is operational risk.
How so?
You cannot ask a cement factory manager to halt their production line, a line that runs 24/7 and generates millions in revenue, just to test out a startup's unproven prototype.
Oh, of course. Plant downtime is financially unacceptable.
Exactly. So traditional venture capital, which operates on 10-year fund life cycles and wants quick validation and an IPO, just walks away from the foundation of the house.
But the article frames this not as a failure of the market, but as a massive strategic insight for you, the listener.
Yes. Because traditional finance is scared of it, this gap is your opportunity.
Right.
If you can provide near-term innovation with measurable return on investment in heavy industry without disrupting their core operations, the market is wide open for you.
It's wide open.
Literally. If you can offer a bolt-on technology that captures exhaust heat and turns it back into electricity for a steel plant, giving them immediate energy savings without stopping the forge, you essentially have no competition from the hype chasers.
Which brings us to a massive shift in how these foundational fixes are actually getting funded.
Yeah.
Because if traditional VCs are running away from the high capex heavy industry, a new power player has stepped in to fill the void and scale these physical solutions. The corporates. The report highlights that corporate players took part in 28% of all deals in 2024. And this capital is heavily skewed toward the later stages.
Very skewed.
Yeah, 61% of corporate investment is in that mid to late stage, compared to only 33% for traditional financial investors. So what does this all mean? If you are a professional or a startup founder listening right now, why should you care that a massive corporation is writing the check instead of a venture capital firm?
If we connect this to the bigger picture, a corporate partner offers something a venture capitalist simply cannot: real-world integration.
Right.
Corporates aren't just writing checks and sitting on a board. They provide faster validation through real-world pilots within their own massive, already established distribution channels and global supply chains.
But hold on, let me push back on that for a second. Corporations are notorious for being obsessed with next quarter profits and shareholder returns. Why would a corporate giant suddenly be okay with a 10-year payback period on a new cement kiln or a massive infrastructural upgrade?
Yeah.
That seems counterintuitive to how corporate America works.
It's a great question. The difference is that a strategic corporate buyer is looking to solve a physical problem in their own operations.
Okay.
They aren't looking for a 10x venture return in 3 years. They are looking to protect a multi-billion-dollar core business from future carbon taxes, regulatory fines, or supply chain collapse.
I see.
They are buying resilience. If a technology genuinely makes their supply chain compliant with new laws or hedges against volatile energy prices, they will gladly accept a slower financial payback because it future-proofs their entire empire.
That makes total sense. They are protecting the castle, not just trying to flip a property.
Precisely. And that fundamentally changes how you pitch to them. If you are sitting across from a corporate venture arm, you cannot just pitch disruption. No, corporations hate disruption. Disruption means downtime. You have to pitch reliability. You have to pitch measurable customer outcomes, safety, and compliance.
Right.
You are offering a joint venture or a licensing deal that aligns incentives rather than just asking for equity in exchange for a dream.
So if these massive corporates are investing to protect their empires, what exactly are they protecting them from? The deep dive brings up two of the most urgent physical operational challenges happening right now. Things that dictate whether a corporate supply chain survives the next decade.
Yeah.
First is keeping the lights on grid readiness. And second is physically surviving the weather adaptation to our new climate realities. Let's look at the grid first.
Grid readiness is becoming the critical bottleneck of the 21st century. I mean, we are deploying intermittent renewable energy, wind, and solar at unprecedented rates.
Which is great.
But our current electrical grid wasn't designed for power that comes and goes with the weather. It was designed for coal and gas plants that you can just turn on and off with a dial.
Right, and the article points out this requires a massive convergence of physical hardware and orchestration software. On the hardware side, you need long-duration storage at a system scale.
Exactly.
And I want to be clear here. We aren't talking about the lithium-ion batteries in your phone or an electric car, which usually max out at about 4 hours of storage. We are talking about multi-day firming, technologies like iron-air batteries or vanadium redox flow batteries.
And the mechanism of how those work is fascinating. Unlike lithium-ion, which degrades over time and uses expensive, flammable materials, an iron-air battery literally uses the process of rusting and unrusting iron to store and release energy over several days.
That is wild.
It really is. And a vanadium flow battery pumps liquid electrolytes from massive external tanks to generate a charge. You can literally just build bigger tanks to hold more days of power.
Just scale the tank.
Exactly. This is crucial to prevent what's called curtailment, which is when the grid operators literally have to throw away excess perfectly good solar power at noon because the grid cables physically cannot handle the surge.
It's an incredible engineering challenge. But those massive rusting batteries have to be paired with incredibly smart software because the grid is no longer a one-way street from a power plant to your house.
Right. You have millions of what we call distributed energy resources, or DRs. Think about a neighborhood where every house has solar panels and an electric vehicle in the driveway.
Okay.
Without software, if everyone plugs in their EV at 6 p.m. when they get home, the local grid collapses. Orchestration software acts as an invisible traffic cop. It communicates with the cars to draw power when solar is abundant and perhaps even pull power out of the car batteries to support the grid during peak demand.
So that's keeping the lights on. But the other side of this real-world integration is adaptation and resilience, or A&R. Basically, surviving the extreme weather we're already locked into.
Yeah, A&R is vital right now.
And there is a fascinating statistical quirk in the data here. The article notes that adaptation and resilience made up 28% of all deals, but only 12% of the total investment value.
That is a critical data point. What it tells us is that A&R is completely dominating the early stage landscape, but it hasn't matured into massive late-stage companies yet.
Oh, I see.
Investors are deploying a huge volume of very small checks into proof-of-concept rounds. We are talking about drought-tolerant crop seeds, sensors that detect structural stress in bridges during heat waves, AI systems designed for early wildfire detection.
Wow.
Yeah, and a whole wave of algorithmic insurance innovations to price these new unpredictable physical risks. But there is no billion-dollar exit in adaptation yet. No one has built the Google or Facebook of climate adaptation.
It's like playing Moneyball. That's the analogy that comes to mind. If you've seen the movie or read the book about the Oakland A's baseball team,
Oh, perfect analogy.
right, investors in the adaptation space right now aren't swinging for a single massive $100 million home run. They are looking for a high volume of reliable base hits.
Exactly. The math is all about portfolio survival. They aren't funding one giant green steel plant. They are buying 50 separate small stakes in drone sensors and drought seeds.
Right.
They are making dozens of small, early-stage bets through grants and corporate pilots, hoping that a few of these targeted solutions eventually get absorbed into municipal city budgets or massive corporate procurement pipelines.
But playing Moneyball with small pilot programs takes time. A startup might need a 5-year testing runway to prove their drought-resistant seeds actually work across multiple harvest seasons.
Oh, easily.
So how do these innovators survive that timeline when the government policies or tax credits funding them might literally flip in the next election cycle?
This raises an important question, perhaps one of the most important questions for any project developer right now.
Yeah.
How do you underwrite policy exposure? Underwriting basically means calculating the risks and deciding if the math still makes sense to invest. The U.S. market held remarkably steady recently, as we mentioned, largely because of the massive tax incentives in the IRA. Capital craves certainty, and the IRA provided a baseline.
But as you pointed out, a project might take 5 years to build, and the political landscape can change in 2.
Exactly.
So how are the seasoned investors navigating that friction?
The data shows they are essentially stress testing their financial models. They are taking their cash flow projections and running them through alternate worst-case political realities. And practically, they are using mechanisms like safe harbor rules.
Wait, for those of us not deep in project finance, how exactly does a safe harbor rule let you lock in a tax benefit early?
A safe harbor rule essentially allows a developer to legally qualify for today's favorable tax rates if they spend a certain percentage, say 5% of the total project cost right now.
Really, just 5%.
Yep. So they might buy 5% of the solar panels today and put them in a warehouse, which legally safe harbors the project under current policy, even if they don't finish building the solar farm for another 4 years.
Wow. It's literally buying a time machine for your tax rate.
Exactly. It's brilliant. And most importantly, they are stacking those policy benefits with corporate power purchase agreements, or PPAs.
What's a PPA?
A PPA is a long-term contract where a major corporation agrees to buy the electricity your project generates at a fixed price for, say, 10 or 15 years. So even if the political winds shift and tax credits vanish, you have a guaranteed buyer and guaranteed revenue.
They are pricing in the risk of uncertainty.
Precisely.
And to survive that level of scrutiny, the article synthesizes a forward-looking playbook.
Yeah.
A 3-step guide for navigating this maturing, highly disciplined market. Let's lay out that playbook for the listener.
Sure. Step 1, sequence your development into short, testable milestones. You cannot try to boil the ocean. You break your massive 10-year R&D goals into a small lab pilot, then a slightly larger validation build, then a small customer trial. Each milestone has to buy a meaningful reduction in technical and commercial risk before you ask for the next round of funding.
Makes sense. Step 2 is where the data really takes over. Validate performance with precise meter-level data. The acronym you need to know here is MRV: measurement, reporting, and verification.
Yes, MRV is critical.
Because investors and corporate buyers no longer accept broad, fluffy claims about going green or simply buying carbon offsets to look good on paper.
No, absolutely not. They want to see the exact mechanism. They want sensors on the exhaust pipe proving the exact per unit emissions cut. They want to see the exact kilowatt-hour energy savings on the meter or the exact yield gain in the crop field.
Unassailable proof.
Without rigorous, unassailable MRV, your project is completely unbankable in today's market.
And step 3, blend your revenue streams. You can't just rely on venture equity anymore to get from a lab idea to a commercial factory. The playbook dictates blending capital logically. You start with a non-dilutive government grant to build the prototype, Then you secure a little early pilot revenue from a forward-thinking corporate partner.
Yeah.
Finally, once the tech is de-risked, you use project finance, which is traditional debt from a bank, to build the actual massive facility. It's about structuring your funding as intelligently as you structure your technology.
That playbook is the ultimate antidote to the hype cycle. It's measured innovation. It's a disciplined execution.
Yeah.
And whether you are building a new type of carbon sequestering concrete or software to manage electric truck fleets, adhering to those 3 steps, testable milestones, strict MRV, and blended capital, is how you unlock growth in a tight, mature market.
It's all about proving impact per dollar. So as we wrap up this deep dive into Felix Römer's incredible data, I want to leave you with a final, somewhat provocative thought to mull over.
Oh, I'm ready.
We've talked today about how AI optimization and massive corporate supply chains are becoming the dominant forces pushing climate tech forward. We've talked about the shift from flashy hardware hype to gritty operational efficiency and survival.
Right.
So the question is, will the next massive green tech unicorn, the next generational company, even look like a traditional climate company?
That's a great question.
Right. Or will it just be an invisible, highly specialized data analytics firm that happens to make global cement factories and steel mills wildly efficient behind the scenes?
Wow. Yeah.
It might not be a company boasting with green leaf logos about saving the world. It might just be a software tool that heavy industry literally cannot afford to operate without, something for you to explore on your own.
That is a fantastic point to end on.
Thank you for tuning in to the SmartKeys podcast. We really appreciate you spending this time with us to level up your understanding of where the future of business and sustainability is actually heading.
It's been a genuine pleasure unpacking this data with you. The shift from hype to discipline really is the best thing that could happen to this sector, and understanding the mechanics behind it gives you a massive strategic advantage.
Absolutely. If you found this deep dive valuable, we highly encourage you to hit that subscribe button so you never miss out on these strategic insights. And please, do yourself a favor and read Felix Römer's full, incredibly detailed article. We've placed a direct link to it right in the show notes. Dive in, look at the charts yourself, and start applying these frameworks to your own work. Until next time, keep innovating and keep looking forward.